All right, let's talk finance 101. If you're an entrepreneur and you don't want to crater your business, you have to be able to speak the language of business. And the primary language of business is the language of accounting. There's three things that I want to talk about, three metrics today, three ideas that a lot of people get confused about. They don't really understand the nuances or the differences between them. And because they don't understand the differences, they often treat them as synonymous, one and the same. And then they wake up one day to realize, oh my God, these are not the same thing, and I am in deep doo-doo. So let's talk about the difference between revenue, profit, cash flow. So first, revenue. Revenue is the number everybody, every guru online likes to cite. They're like, oh, we did $100,000 last month. We've made $20 million of sales in the last year. I've helped $1 billion of business, right? That's your top line. This is what's called top line, because when you look at your P&L, your profit and loss statement, the very top of it is your revenues. That's what you sell. So all the things that you sell, that's your revenues at the top of the thing. Now, the reason everybody likes to cite revenue is because it's the biggest number on your P&L. The numbers, your profits and your cash flow, they only ever get smaller because you start to remove all your expenses, and then you get to what's left over at the bottom of the profit and loss statement. That's why it's called the bottom line. And the bottom line is your profit number, right? So at the top is your revenue and the bottom is your profit. They're about as far apart as you can possibly get. Okay. And that is a very important mental note to make, because when somebody says, hey, we did $100,000 last month, and you ask them, like, what's that mean? Do you mean $100,000 of revenue? Do you mean $100,000 of profit? $100,000 of cash flow? Because these are different things. In a lot of cases, when somebody says we made $100,000 last month, they're talking about revenue, because it's the bigger number, it's the more impressive number. And if they're running at, say, a 20-30% margin is the number after you remove all the expenses, what's left over, right? Your profit is after you remove all your expenses. Profit is what remains. Profit is what can be kicked back to you. It can go into savings, it can go back to investors, whatever. Profit is what remains to be distributed after the fact. Now, the difference between profit and revenue is your margin, right? And so if you're doing $100,000 a month of revenue and you have, let's say, we'll just throw out 40% margin, then you have what did I say? 100,000 to $40,000 at the end of the month would be your profit, right? That's your gross margin, and then you can go into net margin, all these other, there's a lot of nuances here. I want to keep this high level though, so that you can understand this from a fundamentals perspective and why these numbers are so different. And I want to tell you about which is actually the number that matters at the end of the day. Like, as you can tell so far, like, I don't think very highly of revenue. Profit is great, but it's also not the most important. So that leaves one other that I've kind of alluded to. So just bear with me. Okay, so if you have your revenue, you're doing $100,000 a month, you have a 40% margin, that means $40,000 is left over at the end of the month in profit. That's a very different thing to say to somebody of like, oh, we did 40,000 last month versus 100,000. So that's why most people say, oh, I did 100. They want it to be more impressive, right? Now, in a lot of cases, when those people are saying things like, oh, I did 100,000 last month, and they're trying to impress you with those numbers, often they have terrible margins. In my experience, they might have 5-10% margins. So they might do $100,000 of sales, but of that, they only keep 10,000. And so they're running at a 10% margin. That's not a very good business, by the way. Like, those are pretty thin margins, depending on what you're selling. If you're a grocery company, a grocery store, like, that's not so bad. In fact, that's pretty damn good. But that's why knowing the difference, when people are saying I'm doing X, Y, Z, like, what's that actually mean? Now, revenue is for what people say, revenue is vanity, profit is sanity, right? At the end of the day, I don't care about what your top line number is. If you're doing $100 million a year, but you're spending $99 million to run that business, then at the end of the year, you only have $1 million to show for it. That's $1 million. Don't get me wrong. That's not too bad, right? But that's 1%. That's 1%. That's not great. That's a terrible business model. That's horrible, right? In a lot of cases, you could even have $1 billion business where you're spending $1.1 billion, right? So it's like, oh, that's your revenue number doesn't matter, because it doesn't tell us anything about how well you operate the business, how profitable it is. At the end of the day, the business doesn't exist just to sell things. It exists to make money. You make money by selling things. Now, if you sell things and you're not making money, you have a you don't have a business, you have a hobby, and it's going to be a hobby that bleeds you dry sooner than later. So do never get it twisted. The purpose of a business is not just to sell things. It is to sell things to make money. And that's why profit is the more important number between that and revenue. We want to know how much do you actually take home at the end of the day. Now, depending on your different business models, at Escape Climbing, where it's a manufacturing environment, we run that at a 30 to 40% margin. That's fantastic there. But that would be a horrible margin for something like my media business or, consulting. If I'm running at 40% and, it's an information product where I just have to go in and trade my time for money and consult, that's a terrible ratio. That should be closer to 80, 90% in some cases. If I'm a software, that could be 95%. If I have a software and I'm doing 70, 80%, like it's a horrible business model, right? Then again, if I'm a grocery store and I'm doing 10%, hells yeah, that's great. Because grocery stores, they have the thinnest margins along with restaurants. It's horrible. Don't do that. Don't be one of those guys. Get into something with better margins. It's usually easier to make money. Anyway, so revenue, profit. Now let's talk about cash flow, because this is the one that fucks people up. This is the one that will kill you if you do not understand the difference between profit on the P&L and actual cash flow. Now, the three holy grail financial statements inside of a business is your P&L, your cash flow statement, and your balance sheet. You cannot actually know the full health of a business if you do not have all three of these. The problem that a lot of people will run into is they'll run their entire business off of the P&L. That's showing what they sold versus how much it cost. That's not good enough, because the other two statements, the balance sheet is going to give you a snapshot in time of all the different assets and liabilities that are within the business. That's different loans, amortization and taxes. That's different assets. If you have, real estate, a mortgage, like that stuff is reflected there. So you get a better picture of the net worth of the business, right? But the cash flow statement tells you the truth of the business, and it tells you how much cash do you actually have coming in and on the timing in which it's hitting versus when the money is leaving. For instance, this is where things get really crazy, right? Let's say you make a $10,000 sale today. That you could put on the revenue, the P&L. You could say we made $10,000 of revenue today. But when did the money hit the bank? When did you receive payment? Because let's say I make the sale today, I send them my invoice. But the invoice, they sign the contract and they get the invoice. The invoice is, let's say, on net 30 terms, which means they have 30 days from the day in which the service is rendered as the day they receive the invoice to pay. That's very common in business, right? So if, let's say I'm a vendor and I'm going to go do work for you, I give you my invoice, you don't actually have to pay it for 30 days. That is good for you as the person trying to pay the bill because you have longer to pay it, right? This is how a credit card works. You use the credit card and then you don't have to pay it for 30 days, right? So you have net 30 terms on your credit card. This is great for you. Now, if you can get net 60, net 90, that's even better because it gives you more time to stretch out that debt. Now, if you are the one that is selling the product, I sold you $10,000, but I'm not actually going to get that money in the bank for 30 days. That's a really important thing to know, right? Because if you're sitting down at your sales meeting with your leadership team and you're like, last week we made $50,000 of sales. Cool. If you use that information to then go spend $50,000 to invest $50,000 in that new equipment that you had your eye on, you might be up shit's creek because nobody told you, oh yeah, we made those sales, but we haven't realized the revenue yet. We actually haven't gotten paid, and we're not going to get paid for another 30 days, maybe 60 days, maybe 90 days, maybe never days if they decide not to pay you, right? So I see so many businesses run off the P&L. They're looking at what their sales were instead of what was actually cash collected, cash coming into the bank versus when cash is leaving. And it's very easy to get into this disparity where you send out a check, let's say, and you're like, I had the $25,000 bill. I'm going to send out this check. You send it to the vendor. It gets lost in the mail, or for whatever reason, the vendor doesn't cash it for a month. This happens all the time, right? And then all of a sudden they cash the check. You forgot that you had sent it because you look at your bank account and you're like, I have the money there. And at a certain point, you just kind of assume that they had drawn it down. They had cashed the check. And so you look at the bank account, you see, oh, I have this money in here, and you spend it, forgetting that this person had this check outstanding that they hadn't actually cashed yet, right? So this is cash flow management. If you don't have a system for tracking what outstanding payables or outstanding receivables you have, when the timing of these are all going to hit, you find yourself in these weird situations where it's like, well, I made $100,000 of sales last week, and my bank account says I have $100,000 in it, so I must have $100,000. Like that matches, right? It's like, well, did you actually get paid for that 100,000, or is that coming in 30 days? That 100,000 that's in the bank, did you actually also have $100,000 of taxes that is getting pulled out next week? Like, is that money actually usable? This is where the game of business can really trip people up. If you don't understand your P&L, your cash flow statement, your balance sheet, and the timings of when things hit, you're going to find yourself at the end of the month. This is the one that gets people at the end, is they get to the tax season, and then they're suddenly like, oh, I had all this money over here, and I forgot I had this big bill coming. I wasn't prepared for it. So what looks like profit and positive cash flow over here is suddenly all gone, and your bank account goes to zero or negative, and you're like, oh shit, now what do I do, right? So understand the difference between revenue, profit, cash flow. At the end of the day, profit is the number that we care most about because that tells us how thriving the business potentially can be. But cash flow is the one that's the lifeblood, because if you don't have the cash flow to pay the bills when you need it, then it doesn't matter how much theoretical profit you have, you're going to go out of business. And this is one of the easiest tweaks to make, by the way. I had a new student on board back in September, very, very experienced business entrepreneur himself. And on the very first call that we had, he was having this cash flow crunch issue. He's like, listen, I made like $50,000 in the last 2 weeks, but I only have like $8,000. And he was telling me this on that call because he had a hard time justifying my fee for paying me. He's like, I would love to work with you. I have the revenue, but I don't have the actual money in the bank yet. And he's like, so once I get paid, I'll do that. And I was like, how about this? You pay me right now. We'll hop on that very first call, and I will show you on that very first call how to make me pay for myself. And he's like, okay. So we do that. Hop on that first call, and I go, here's what you do. Stop offering people payment plans. Stop it. So he was coming in and he's like, I'm selling this $5,000 product, but then I'm giving people 3 months to pay it. I was like, just stop that. So instead of collecting, $1,700 right now, $1,700 next month, or $1,700, and I'm throwing out numbers, I don't know if that was exactly right. Probably about right, $1,750 or so. Instead of only like making a $5,000 sale and then only collecting $1,700, just say, here's the price. It's $5,000. Do you want to put it on cash or check, ACH, wire? How do you want to pay? Just don't give them the option for payments. And he's like, well, what if people then don't want to do the thing? I was like, well, then you can work backwards and work out payment plans as necessary, but you want to collect as much as you possibly can in as short a period of time as possible. So instead of breaking it up into 3 payments, you say, okay, you can't do it all right now. How about 1 payment now, 1 payment in 2 weeks? Why does it have to be a month? Like, why? Like, condense your cash conversion cycles and you will make more money. He's like, okay. So he hops on his sales calls later that afternoon, has this new strategy, pay in full, no payment plans. He comes back to me and goes, cool, you paid for yourself. I was like, yeah. So if you want some help, if you're a business that's doing at least $100,000 to, say $3 million a year, and you want some help going to $5 to $10 million a year, go to beyondtheapex.com and apply for the group coaching program. Seriously, it will pay for itself. It'll be the best investment you've ever made. We'll break down all the systems, frameworks that you need to plug into your business to help it skyrocket to that next level. But more importantly, we're going to save you the headache of spinning your wheels and trying to figure it out on your own. Because I'm just going to crack open your machine and look at it and be like, that's the problem right there. Here's the solution. Plug it in. You're good to go. Now all you got to do is go do the work. That's the hard part. But that sounds like you. You want some help? Go to beyondtheapex.com. I would love the opportunity to work with you. Otherwise, just subscribe to the podcast. Keep consuming the free content. I love having you guys here. Truly, it means the world to me. And I'll see you back here tomorrow.